Right. So basically, we've had so many analysts, and frankly, all the commentary from the street community telling us we're going to have a nice run up in 2011. Kind of the stage is set. You're in the bearish camp. Explain to me why you've got concerns about next year's markets.
Yeah, Cheryl, I am, and I'm specifically bearish when you compare the U.S. to overseas markets, specifically the emerging markets. There's still a lot of wild cards in the U.S. It's not that we haven't seen some short-term positive signs, but to me they're not significant enough to give us a bullish sign on the overall U.S. markets. You know, we still have the unemployment problems. There's still many wild cards out there, and the opportunity is where there is growth, and growth can be found specifically in the emerging markets where unemployment's lower, they don't have the debt issues that we have, and their GDPs are not only stronger, but they're sustainable GDP ratios.
And you know, Matt, I mean, one thing about that he brings up emerging markets, and we've talked a lot about growth in China, but if growth slows in China, Matt, that could be a reason emerging markets could go the other direction.
Certainly. I mean, everybody thinks China will almost have an unyielding supply of growth and returns, and I think it's a communist country. Of course, they can make up any numbers they want. However, where I look at next year, I do agree with Rob that there are many wild cards in the U.S. I'm so on the market and economy, but I'm very optimistic about high-quality dividend-paying stocks. That's all our firm specializes in. We've been very focused on this area. It seems that the market is a little bit frothy right now, Cheryl. It is somewhat of in a topping pattern. Sentiment is very high, whether it be the VIX that are levels prior to the spring correction, or you see the AAI number, sentiment number is back to pre-Lehman levels. You're seeing a lot of people thinking, hey, all is okay with the world. And I think what my recommendations are for investors to be very selective, do your homework, understand that we could see somewhat of a topping pattern and more volatility in the beginning part of this year. But if you focus on companies with dividends, you do have some downside protection, you do have more income. And I think next year, I'm realistic about the market. I think it's going to be an okay year, probably not as great as many other people expect, so I'm mildly optimistic.
All right, Rob, mildly optimistic, but he mentions in a way you could look at dividend-paying, Rob, multinational companies. That could be one way to kind of do what you're saying, which is look at the emerging markets, but also protect yourself against what could happen in particular in China or other areas, Europe, that could slow down, Rob.
You're right, and that's not a bad part of the overall strategy, and he's right, Matt's right, you need to be selective, and the multinationals could be part of the portfolio, but unfortunately a lot of people get ahead of themselves and they're over-invested, not only in just U.S. equities, but they're over-invested in the markets in general. We serve people ages 50 plus exclusively, and the number one problem we see when they first come to us is they're over-invested. So it's okay to have some of those multinationals, but to a certain degree, a prudent level of risk.
All right.
And, the growth really is...
Sure. Well, Dennis Neal wants to hop into this really quick. He's about to jump out of his seat. I can't deny Dennis Neal.
And let's caveat it all with the fact that these two gentlemen get paid for their stock advice, and my advice is worth what it costs. It's free. But I just want to raise the question, Rob and Matt, whether you're being too pessimistic, too timid. Capitalism is optimism monetized. A lot of stock pickers were awfully down on the market when it was at its lows of 6,600 and 7,000 in the Dow, and they said stay away as the Dow proceeded to rise 80%. Rob, a year ago, weren't you even more pessimistic than you are now? And yet, look at how stocks have done.
Yeah, and that was right. And we helped clients make sure they had a prudent amount in the markets, not to be overinvested, because when the market was at 14,000, a lot of people said, oh, it's going to keep going up. And then it went down to 6,000, to your point. The correct thing is having the appropriate amount, and you can use the prudent investor rule, the appropriate amount in the markets. I was more pessimistic a year ago this time because we're starting to see some short-term signs here in the U.S. stateside that are positive. But I still point overseas. I still point overseas where there is growth actually happening.
So what percentage should you have in equities? Because I know it's the old thing was 110 minus your age. But what percentage of your portfolio should be in equities?
Honestly, it's custom tailored to each individual client situation. You will use the prudent investor rule 100 or 100 minus 10 your age. And the result is the maximum percentage. So if you're 60, the most you should have at risk is 40%. And for our clients, it depends on what level of risk beyond that is emerging markets versus domestic.
Yeah, let me take.